Okay, I think I'll get it going now. I think 3 minutes is enough to be on time. So let's get straight into it. So firstly, just a bit of introduction to myself and the business, right? Myself, some of you may know me, been a bit around in the financial services industry. Um, am a certified financial planner, about plus minus just over 25 years in banking, financial services, financial planning. Most of it spent working with financial advisors, training and developing financial advisors, and supporting financial advisors. Together with what I saw happening to most financial advisors' clients, I started noting a shift in the market regarding their clients. Advisors were saying that clients were lapsing their policies or reducing their premiums or even withdrawing from their investments. Upon looking closer into that, what I actually noticed is post-COVID, a lot of South Africans have been struggling financially. And what I also noticed is that there was a lack of professional guidance for those people to actually help them get out of where they were. It was on that basis that we formed the Financial Educator. Why? We found that financial education was the primary issue when it came to people ending up in financial distress. Along with not there being sufficient tools and guidance to get these people out of financial distress, coming from a financial planning background, I then saw the opportunity to help these people through the same principles of financial planning, but starting by getting them out of debt first, right? So that is the base on which we were formed and the background on which the financial educator was formed. A bit of a tongue twister there. Okay, so today's agenda. So if you just mind, I just need to get my timer here so I make sure I don't go over time. So today's agenda, what we'll do first is look over the actual South African debt landscape. And what I discovered here, I think was quite an eye-opener. Next, we're going to look at two key elements in why I believe that a lot of clients end up in a situation where they are over indebted. Two things. Number one, not understanding the difference between good debt versus bad debt, and the cost of credit, underestimating how much those loans actually cost them. Then we'll go on and look at how you can actually including debt in financial plans. So we know traditional financial plans typically look at wealth protection, wealth creation. But what I have found is a lot of the clients I've dealt with, whether they do want to create wealth, but they effectively in a negative position where they can't even get out of debt, let alone create wealth. Then we'll actually look at debt relief options available in South Africa. And finally, how you as a financial advisor or financial planner can partner with the financial educator in order to improve your offering to your client. So let's start by looking at the South African debt landscape. So I don't know how you may be aware, but South Africa is actually facing a financial crisis. According to the National Credit Regulator, 73% of South African households are over indebted, meaning they cannot meet their debt obligations. If we look closer at some of those figures, 45% of credit consumers, not the word that I like, or 11 million, so it's roughly about 26 million credit consumers in South Africa, 45% are one or more payments behind. Of that, 35%, roughly 7 million, are in what's known as default, 3 or more months behind on the payments. And that is according to the Credit Bureau Monitor. The impact on you as financial advisors, well, I've been seeing it all along. I speak to advisors every day. So, Anwar, my clients, they are lapsing their policies. They are reducing their RA contributions. Even worse, two-pot withdrawals happening on a daily basis. Withdrawals from unit trusts that used to be emergency funds are now being depleted on a regular basis. This is the impact we are seeing directly. Now, what is very important, I think we need to understand, is that initially I thought it was a problem amongst lower income levels. But the deeper I looked into it, I noticed that it was actually across the board. Now, what is important to understand that different income levels experience different forms of, let's call it debt stress or financial distress. In the lower income groups, typically under 15,000 Rand per month incomes, there would be clients borrowing for essentials. Think of it as payday loans, furniture store accounts, clothing accounts, etc. When it comes to middle income people, that is considered to be between 15,000 and about 30,000 a month. We're talking about lifestyle creep, buying cars that are too expensive, credit cards, consumption of luxury goods that actually shouldn't be consumed in that market segment, eating out quite often, right? Then when it comes to the high income groups, typically those will be groups of 50,000 income and above per month. What we find is a lot of over leverage, buying a property with a bond that they couldn't actually afford, buying a vehicle with a repayment that they couldn't actually afford, having credit card limits with multiples of 100,000 limits, and spending on those cards. What happens? You create a massive amount of repayment stress, which and in the end leads to over indebtedness. So let's look closer, and this is where my eyes really opened. Initially, I thought it was a low income problem, but when you look at the figures, we see that nearly 3/4 of all overdue debt sits with the top three wealthiest segments, showing that the stress is actually at the high income earners. Now, if we look at the category, and this is according to the Experian Credit Bureau, the highest category, or the upper 10% of income earners, known as the heavy hitters. Think of it as a gross income of 50,000 and above, or a net income in the region of about 35,000 above, are responsible for roughly 11 billion overdue home loans, right? Up almost 6% quarter on quarter compared to last year. All overdue balances almost up 5%. So that is people earning 50,000 above, increasingly facing debt stress. The average monthly installment, as you can see, is just over 20,000, with roughly half of the income going to debt repayments. Now, I must note that 48% is 48% of their gross income. When you start looking at net incomes, you're finding that up to 75% of people in this category earning over 50,000 a month are paying towards loans. Think your bonds, think your car repayments, think your credit cards, think your revolving credit loans. Those are all adding up. If we just look at the next segments, the middle class, categorized as earning typically between 15 and 30,000 to 35,000, massive also. Also, overdue balances going up by about 5%. They're the big driver. Credit cards, vehicle finances, balloon payments, etc. And then, strangely enough, the so-called comfortable retirees, even people in retirement, are facing debt stress, increased inflation, increased medical costs. People over the age of 65 having to take out debt to cover medical bills. That is becoming an increasing reality. So how do these clients end up in the situation, right? So having seen a number of financial distress clients over the last year, ever since I've started this business, or I shall say even the project, there was a few key things I noticed. That number one, most people don't understand the difference between good debt and bad debt. And number two, they don't understand how much their credit actually costs. Right, so let's look a bit closer into this. Firstly, good debt versus bad debt. What are the core principles? Because despite what some may say, there are certain type of debts that can actually lead to financial prosperity, if I can put it that way. So good debt typically is debt where you take that amount that you've borrowed and it invests in appreciating or income generating assets. For example, buying a property, a student loan where you're going to have a education qualification that will increase your income, a business loan where you'll be able to generate income. A key trait is that there's potential for long-term growth, whereas bad debt, it funds either depreciating assets such as vehicles or short-term consumption, TVs, eating out, etc. And typically, it will be your credit card debt, luxury car loans. Now, I know vehicles are a contentious issue because vehicles are expensive, and to a certain point, most people have to buy a car on finance at some point in their lives. But when you are buying a vehicle and the repayment makes up 30% of your income and it's 20,000 a month, it can cause a bit of financial distress. A key trait is they have high interest rates and there's no return on investments, meaning that you are actually getting poorer. Now, just an example of good debt in action. You have a degree or a trade qualification that actually increases your lifetime earnings. With real estate, as you know, you can let out real estate, even if it is your home that you have, you can, even if it is a home that you go with, you can increase the value of your home over time. Of course, with the business, if you have a business, you can generate the income to make up for that amount you borrowed. And how it works is, yes, you borrow at a lower interest rate and you get a return from what you've invested in. And in some instances, like a business loan, it can also be tax deductible. One thing to note, though, is that overborrowing or poor planning can turn good debt risky. For example, yes, buying a home with a mortgage, the home is going to appreciate. But if you're buying it for too much what you can afford, I've seen many instances where clients come to me where the reason they become over indebted is that they bought a property they could not afford, where they underestimated how much that property would actually cost. That was not just the bond repayment. So yes, good debt can be beneficial, but with poor planning or overborrowing, it can lead to financial distress. Now let's look at bad debt and what are the common culprits. Your credit cards, often 20% annualized interest that you're paying on non-essential purchases. Think along online stores. You think you're getting a 15% discount, but you're paying 20% interest on it. Car loans, that car loses 20% of its value in its first year. Meanwhile, you're paying close to 60% over and above the actual purchase price of the car over a period of 5 years. Just so you know, car loans to the tune of 96 months are now being granted by banks. That is 8 years. Think about the amount of interest on that car loan. And then something which I think is the work of the devil himself, payday loans, which somehow is able to charge interest by calling it fees. And some instances, if you analyze, it can be up to 400% annualized interest with those payday loans. Of course, the consequence from a financial point of view is that you are eroding savings through paying compound interest. Remember how we're always teaching clients the benefits of compound interest and how you can grow your money? Well, you experience the exact opposite, where it's draining your wealth as you're paying compound interest. Of course, it does also limit future borrowing power when you cannot keep up with it, when you do maybe want to invest in the business, when you do want to buy a property, and it creates stress and financial instability. Now, another thing that many clients are not aware of is the cost of credit. Why? They would borrow an amount, not knowing actually how much they're paying back, only looking at the repayment. Now, just for those who are hawk-eyed might note that the repo rate has had a slight change. So you can see that was as of July 2025. So I'll remember to update that for the next presentation in case someone has a comment. But why does credit cost more in South Africa? So relatively to developed economies, our interest rate is still quite high, especially if you consider that our inflation has come down now to the lower end of 3%. Add the fact that things such as credit life insurance is mandatory in a lot of loan accounts, especially your unsecured loans. It does add 3 to 5% to that loan contribution. Add initiation fees, service fees, you have another 1,000 Rand added upfront, maybe another 100 Rand every month, etc. Coupled with the fact that unlike your home loans or your vehicle finances, that your personal loans typically charge interest anywhere from 15 to 27%. your credit cards anywhere from 20 to 25%. Now, this was an interesting exercise that I did with the client, and I showed that her 100,000 Rand unsecured loan she took out, which she thought was a nice manageable repayment, would mean that you'd end up paying 200,000 Rand back just in interest, never mind the credit life and those other fees involved. And I don't know if you guys have seen a lot more of these SMSs come through. You now qualify for a 300,000 Rand loan, unsecured. You now qualify for 200,000 loan. These loans typically charge 28% interest and are taken out over a period of anywhere of 5 to 6 years, meaning that that client will pay more than double the amount they actually borrowed in interest. And what the most discovered is they do not even know this. Why? They simply look at the repayment and they think, oh, I can afford this, and they take out that loan. 2 3 years later, when it catches up with them, unfortunately, they end up in front of me. Now, let's move on to the next step. How do you, as a financial planner, actually include debt in your financial plans? And having worked now closely with a few financial planners in the last year, seeing how we can work together, one of the things I always said, Anwar, my client will come to me, either he's about to lapse his policy, or he has lapsed his policy, or he's making a withdrawal again, or he's saying, you know what, I can see something's happening here, I need to do something about it. And he comes to me and we sit down with the statements, and quite honestly, I can only do so much as a financial advisor. Well, the first thing we can do is to address the elephant in the room. And we find that many times clients won't even be upfront to their financial advisors about the actual debt situation, which is quite ironic if you ask me. Why? They feel shame, overwhelmed, and very often denial. What you will find, especially someone who earns a higher income, if somebody is earning 50, 60, 100,000 a month, and to be quite honest, 80% of my clients that I've seen have been referred by financial advisors, and an overwhelming majority are private banking or premier banking clients that have high incomes. And often what they try to do is, in order to fix the problem, they end up taking more and more debt. While they have a high income, they have a good credit score, until they come to a time where it just cannot hold. That's when you start seeing the client coming for withdrawals. That's when you start seeing the policies lapses, for argument's sake. The consequence of the avoidance, not only are your clients overwhelmed, but there's stress, there's anxiety, and often relationship strain within their marriages. And then what happens? Their financial plans that you put out for them, with their retirement plans, with their risk plans, etc., simply falls away. Why? Because all that have been eaten up by debt, and they can no longer can no longer hold up to their financial commitments. So just a quick poll, and I'll take a short break to check the Q&A here. Can you perhaps say, when you see your clients, who of you often directly address debt with your clients? A, never. B, only when they bring it up. Or C, as part of every plan. So let me have a look if I can maximize it and see. Okay, so in the chat or in the Q&A, okay, so we actually have a few C's here. Let's see if there's anything in the Q&A. So you can put it in the chat or the Q&A. Yuri, are there any CPD points for the meeting? I was actually working on CPD points, but it was quite a bit of a process to get it in. So for this particular one, we couldn't get it in time, and I didn't want to hold it up. But the intention is to actually get CPD points as well as FPI CPD points for this meeting, so that when we have it again, that it is also counts towards your CPD attending. So that is something we have applied for, but we're still waiting for approval. But definitely future events, we will definitely arrange CPD points. Okay, so actually I have quite a few C's. Okay, so I'm actually quite happy that it's part of every plan, and that's quite encouraging to hear. Oops, sorry there. Sorry, my just a thumbs up. I think I had a glitch there. Everyone's still fine with the presentation and the sound? Okay, thank you. Just a mid presentation. Thanks everyone. Right. So often what I'm told is, Anwar, how do we actually bring it up? Because it can be a sticky subject. Well, the easiest way to say is, well, let's just review your commitments. The very same way that you review the investments, you review the risk policies or their wealth protection, their wills, etc. In the very same manner, you can review their commitments, meaning their debt commitments. How you do it? Simply, your monthly cash flow, where you can track an income and expenses, and in there you can see those debt repayments being made, or in some cases not being made. There you can also identify the debt burden when you can see, what percentage of this client's income is actually going to debt repayments. And if you want to help them, you can also say, hang on, here is potential to actually pay that debt back quicker. Now, something that is a useful tool to determine whether or not a client is over indebted, and sorry, that is actually meant to say net income. I just picked it up now. But something called the debt to income ratio. If your client's debt to income ratio is less than 36%, so that's whether it's their loan payments, car repayments, etc., is less than 36% of their net income, then it's quite manageable. The red flags is when it's more than 50% or half of its net income. And the highest that I've seen personally was a client where the debt repayments was actually 110% of their net income. Their net income was 21,000 Rand and their monthly repayments was 23,000 Rand. And you ask, how does it happen? Firstly, clients not even keeping track of the expenses, but also a lot of reckless and predatory lending out there, aggressively marketed unsecured lending, loans, cards, etc. And clients that typically are finding themselves under distress tend to go for these loans thinking that it will solve their problem. And then a few months later, they realize that the debt repayment is actually more than their monthly income. So let's just say now you have your client and you have quite a bit of debt that you need to get rid of, and you want to develop a strategy. Uh, Two strategies are typically used for debt repayments. There's what is known as the debt snowball method and the debt avalanche method. So say you sit down with your client, you now have identified, hang on, here's quite a bit of credit card debt, unsecured debt that you need to get rid of while you're paying 20% interest. And remember, there's no unit trust fund that you're going to get a 20% consistent return on return. So ideally, you'd want to wipe off, especially unsecured debt. You'd want to clear that as soon as possible so that your client can start investing considerably more. Now, let's just say you've identified additional funds in the client's budget to pay off their debt sooner. What you can do, you can either tackle it known as the debt snowball method, where you prioritize the smallest debt first, right? So you list them from balances smallest to biggest. And why you do that? Basically for quick psychological wins, getting that feeling of accomplishment. Or if you want to be mathematically correct, you use what is known as the debt avalanche method, where you pay the debt with the highest interest first. Of course, what matters the most is that you choose one that keeps your client motivated rather than one that makes them seem that they cannot get out of this plan. So, which one will suit your client? If you want to have focus where you can see you making quick wins and get that motivation, your debt snowball tends to work better, in my opinion, for most people, despite the debt avalanche method being the mathematically correct method. I feel that most people find the debt snowball method to be easier to stick to because you can see what happens. Number one, you first start by paying off the small debt by paying any extra amount into the smallest debt. As you pay off the smallest debt, you then take the repayment of the smallest debt along with that extra payment and you go into the next one. And as you finish each one, your actual repayment going to the next debt becomes substantially higher and higher, hence the snowball analogy. So effectively, when you come to your largest debt, you are tackling with one big payment that is made up from all previous repayments and extra amount you have. That one tends to psychologically drive clients more because they can see the progress being made from the smallest to biggest debt. However, if someone has discipline, they can actually pay less, pay it off quicker with the debt avalanche method because effectively you're tackling the high interest first. Now, the question comes, and this is where financial advisors have referred clients to me. Anwar, I've sat down with the client's budget, we've chopped and changed it, and nothing is happening. There is simply not, the budget is not budgeting. You are coming out with a negative every month. What do I do? Well, there are certain debt relief options available, meaning methods that you can reduce what you're currently paying towards the debt or the client's debt. Now, the first one that most people typically tend to go to, and this is when the credit record is still quite good, but they are secretly struggling, is either they can go and qualify for a debt consolidation loan where they take all their debts, combine it into one single debt with the overall lower repayment, bringing financial relief on the cash flow, right? Now, how it works, often you'll take out a new loan or credit line to pay off that existing debt with the one monthly payment, often with a lower interest rate. Now, the only problem here is sometimes people would consolidate many loans, but not at a lower interest rate, at a higher interest rate. Now, why would they do that? Because the overall payment would still be less as they would extend the term of all that debt. That is when you can head for trouble. So common tools they can use is personal loans from your bank. Typically, credit card companies also do what they call a balance transfer, where they'll transfer existing balances from other credit cards onto one credit card. And the one where it actually makes sense is with home equity loans. Why? You may have considerable equity in your home loan and be paying a low interest rate. And it might just make sense to actually take on your credit card or personal loan and rather consolidate it into your home, right? What it does is it does streamline the payment and may reduce interest, especially when you're using a home equity loan. What does it look like in practice? We have various loans at various interest rates, and you consolidate into one loan, low interest rate, one repayment. Like I said, in theory sounds great. What I find in practice is often clients will do a consolidation loan, get a consolidation loan of 200,000, and guess what? They still keep the credit card and the other two loans and the store accounts, and they end up owing not 200,000 but 400,000 a year later. Now, the next step, and this is something that a lot of people do not understand they can do, right? It is actually voluntary negotiating with your creditor. So if your client feels they need to miss payments, whether it be a medical emergency, whether it was a job loss, whether they had a reduction in income, where they fear they're going to lose their vehicle or their property through legal action, you can actually speak directly to your bank. And 99% of the time, they will negotiate terms with you, provided that you're not too far gone. Often what happens is people wait for it's too late, and then it almost comes to a point where it's almost impossible to remedy the situation. So the moment there's any type of sign or there's any type of indication, like a job loss, like an illness, etc., that you may be falling behind on your payments, the first thing you want to do is go to your bank, right? What they can do is they can negotiate temporary monthly installments that are lower. They may even reduce your interest rate. They may waive certain fees and actually say, you know what, give you temporary relief. Now, what's important here is this is not necessarily, this would be a voluntary arrangement with your bank, and it is not, and they could change it at any time as well, right? Now, you must also remember that you are protected under the National Credit Act and that creditors must consider affordability. So, if you cannot pay 10,000 Rand, but you can pay 7,000 Rand, your creditors must say, you know what, we will consider it as a reasonable amount. They cannot tell you, no, you must pay the 10,000, especially when it was something like a job loss, a medical emergency, etc. So that is the first point when you can't make payments. However, when it becomes too overwhelming, or if there are multiple accounts at different creditors, that could become a bit more difficult to manage. The question is, what do you do then? Well, One of the options that was introduced and is afforded by the National Credit Act is something called debt counseling. So what exactly is debt counseling? Now, this is potentially a lifeline for overwhelmed borrowers. It is a regulated process that is controlled by South Africa's National Credit Act, where a certified professional, now myself, I am a licensed debt counselor, can help clients manage unaffordable debt repayments, right? What is the purpose of debt counseling? To avoid bankruptcy or insolvency, to restructure the client's payments that can actually fit their budgets, and importantly, to legally protect your clients from their creditors, meaning has your client received a letter of demand? Has your client received a summons? Is your client in danger of losing their property? Is your client in danger of losing their car? Those type of scenarios. Or is your client heading that way? Because often what we find is many times they leave it too late. And when you can see the signs that they're heading there, for example, your debt to income ratios, the early warning signs, which I will show you, we can actually prevent the client from getting to a point where they can actually save all those assets prior to even getting into trouble, right? So why was this law brought into place? Effectively to protect consumers from unscrupulous lending practices, but also to provide legal debt relief measures for those clients who have found themselves over indebted. Now, as many of us have seen, many people post-COVID have really been struggling with debt. I find two reasons come very much into play. Number one, they had quite a bit of debt repayments just prior to COVID, and then lost their income. With that subsequent loss of income during COVID, it took them quite a while to recover to the point where they just about coming right now, and they are still struggling, right? Then there's the other group that I noticed. Those that took out a considerable amount of debt, especially loans or cars, just when the interest rates were at the all-time lowest, just also coming out of COVID. And what happened is, for example, one client, their home loan, when they took it out in 2022, was 22,000 Rand. Within 2 years, it went up to 29,000 Rand. That is a 7,000 Rand increase. How was it funded? Well, credit cards, additional loans. So now, even when the interests have dropped because of the extra debt they incurred in that spiking credit, especially with home loans and cars, they are still struggling to recover, and they are not getting relief from the lower interest rates. So who are the key players? It is a debt counselor, such as myself, that is registered with the National Credit Regulator. They are the creditors, which are the banks and the lenders, and of course, the National Credit Regulator itself. Now, when should a client consider debt counseling? And the one thing I should also note is why we at the Financial Educator also incorporated debt counseling into our offering is that when we looked at what solutions were out there in the market for your clients, we found it, let's just say, to be very not adequate, I shall say. Let's just say that when you looked at the solutions in the market, we found that we're not up to scratch, right? There wasn't real guidance to help clients get out of debt in the same way that financial advisors can help their clients with good guidance to build and protect their wealth. There wasn't the same level of guidance and professionalism to help these clients, I found, largely across the debt counseling industry, right? Now, us bringing this benefit here, well, what can we do? Number one, we can offer, as a debt counselor, or through the debt counseling process, I should say, the client gets legal protection where the creditors cannot harass them, so they don't get those letters, those SMSs, etc., and it cannot repossess your assets. The other thing that happens under the debt counseling process is where there were 6, 7, 8, 9, 10 payments, we consolidate that into one payment, specifically an amount that they can afford, right? So let's just say the client had debt totaling 25,000 Rand across various, their bond, their car, credit cards, and they can only afford 15,000. We will consolidate into one payment of 15,000, and that will be distributed to the creditors, right? In that process also, you negotiate lower interest rates. So think about it. If you're paying 28% interest on your loan or credit card, typically the process can bring it down to single digits, right? Along with that, we also provide financial education in the debt counseling process, Why? We found that an overwhelming amount of clients, what do? They don't budget and they don't track their expenses, right? So in the process, they also taught budgeting and basic money management skills. Now, who is it for? If you find your clients have multiple debts, personal loans, credit cards, vehicle finance, etc. Also, those struggling to meet their monthly payments, where they're just about making it. Now, if you look at the process, what does this process actually entail? Well, firstly, it entails an application from the client where the financial detail is submitted to a registered debt counselor like ourselves. From there, an assessment is made. You look at the income, expenses, as well as the debt repayments. What we then see is, yes, the bank is expecting a certain amount of repayments, but if the budget only allows an amount lesser than that, we then go with that amount, provided it's a reasonable amount, to the creditors and see if we can negotiate a better repayment. Now, what I must mention, typically this process is meant to last no longer than 5 years, right? So it's not meant to be drawn out. And on average, clients will typically belong into it for a process of 3 years. So let's call it 3 to 5 years. Now, in that 3 to 5 years, starting with a negotiation with the creditors to get that reduced payment, right? So once we then come to a finalization of that reduced repayment, we then get it put into order, where it get what's known as a court order. What that does is provides legal protection from harassment and repossession. It also effectively rewrites the rules of that credit agreement. For example, the term of the agreement and the interest rate on that agreement, right? Once your debts are settled, typically, and this is all your debt other than your bond. Now, the question is, Anwar, what if the client's home loan is on there? Well, typically, the client will remain under the process until all the short-term debt, credit cards, loans, etc., as well as vehicles repaid. Once that is repaid, the client then exits the process and they can carry on as per normal, right? Now, just a few questions that often comes up. Well, let's just finish this quickly. So when should you consider referring your client for debt counseling? What are the signs? Well, so far the financial advisor I've partnered up with, the first thing is when they start seeing their lapse report. They see the short term is lapsing on a finance car, or that life cover is lapsing, or that RA is lapsing. That is the first sign, because I can virtually guarantee you 99% of the time when that's happening, because the client is struggling with their debt repayments. When they're missing the actual debt repayment itself, so they're starting to go into arrears, or they're just about paying the minimums. Also, something we've increasingly see is withdrawals via the two-pot system, right? So if you're starting to see more and more clients starting to withdraw from the two-pot system, or surrendering policies that they've had for years, or making repeated withdrawals from unit trust, cashing in preservation funds, very good example, right? Also, when they're taking out new credit effectively to pay for old debts, taking out a third, fourth credit card. And this is the one often when they come to me, and I call it emergency 911, is when they receive legal letters and reposition threats. Now, just to give you some idea, in the last week alone, I've had 3 clients referred to me by financial advisors that have received legal letters or reposition threats to various degrees. One varying from something called a Section 129 notice, which is a letter of demand, to one which was effectively a summons on a vehicle, to another one where there was a notice of execution and judgment on a property. So varying degrees of distress. Unfortunately, in all 3 cases, we were able to assist the client and stop those actions from happening, as well as renegotiate terms with their creditors. And something you'll often see is either their health is being affected by the stress, or their relationships. Now, just in terms of partnering with the financial educator, what can we do for you as a financial advisor, as well as for your client? Now, a few things just to be clear. We are not a FSP, so we do not have a FSP provider, so we are not in competition with what you offer, right? Clear, so that's very clear. We operate under the National Credit Act, as well as we have our various educational services that we offer, and that's something I'll just chat about briefly later. Now, how do we complement your services? If you have a client that you find is financially distressed, or many times what you even find is new financial advisors in the industry is going out there marketing their services, come across clients with high incomes, but they say, Anwar, I cannot offer this client not even income protected because they can't even meet their existing debt. Even those clients, it offers opportunities for you to assist those clients. How? Through debt counseling that we do, which offers immediate relief on their debt repayments, right? Gives them NCA compliant restructuring along with legal protection. Then to couple that as well, financial education, which is your ongoing support, showing them how to budget, showing them how to rebuild their credit score, and something that I found very important to improve their financial behavior, because often one of the other reasons they get him is just bad financial behavior, not tracking expenses, spending more than what they think are spending, thinking that groceries cost 5,000 a month when they're not counting the takeouts and all the restaurant meals. So it's actually 10,000 a month, not counting the coffees that add up to 2,000 a month. So those are the type of habits that we also try to instill them while they're under the process. Furthermore, so with the debt counseling, what can happen? We can avoid defaults, retain assets from repossession, stop bad credit harassments, and in some instances, reduce payments by up to 60%. That's typically on unsecured loans, right? Along with financial education, where we teach them how to build emergency funds, improve their credit, and just show them how to plan for their goals so they can better execute it. For example, how to do savings for Christmas or something for year end, etc. And just a general improving financial habits and behaviors. The benefit to you as an advisor? Well, number one, you retain more clients because you address the affordability issues, which reduces lapses. It also saves you time because you can now focus on your core work, the advisory work, building wealth, protecting wealth, and we handle the debt crisis of your clients. Along with that, we also have a referral scheme or affiliate scheme where you can earn upfront marketing fees on clients referred. Obviously, if you wish to engage in that program, we can chat further amongst that. And then to cross-sell, post-debt clients invest in the insurance and retirement. And to give you some idea, just a few clients we've seen, for example, one client was lapsing their short-term policy. We managed to save that short-term policy. Why we had to, because the car was under finance and it was compulsory. Another client lacked income protection. Through the amount that we're able to cut in a debt, we're able to facilitate the budget so they could have income protection, which was quite important, because without the income protection, anything happened to her, she would become again indebted. So we also look at where we can see that you can have cross-sell opportunities with your clients when we do actually save them a bit of money with their debt repayments. Now, how do you refer your clients to us? We do have a debt assessment or pre-debt assessment form. If I do meet with the office, I'll show you how that form is captured. It is online. From there, we'll set up an appointment to assess the client and conduct a review. You're welcome to join it, or you do not have to if you not want to. From there, we collaborate where you earn your referral. And what happens is when we resolve your client, they return with financially stable return returns to you, ready to invest, ready to insure. Now, just an example, and this was in fact a client referred to by a financial advisor. Names have been changed to protect identity, of course. So if we look at Jared, IT specialist, had a net income of 38,000, a gross income of just over 50,000, had 2.2 million rand in debt, right? Look at that loan repayments, 34,000 rand a month loan repayments with a net income of 38,000. A number of things that led to that. Bought a property what was maybe a bit out of the budget, then needed to make renovations or improvements to properties, or took out additional loans, maxed the credit card. And amongst all that, he got retrenched at his work. Got a job 3 months later, but just before he got retrenched, he took out another loan to cover him. And when he got the new job, had a little bit of a lower income and much higher debt repayments. That is how we ended up in that situation. obviously advisor said, Anwar, here's my client, he's wanting to cancel his short-term and his life cover. When I had a look at the situation, this guy's drowning in debt, and referred the client to me. We then, through the debt counseling process, reduced that 34,000 in a month repayments to 21,000 Rand a month, right? What we had is we retained the life insurance policy as well as protected the home against legal action. Yeah, so just in closing, before I get to questions, just from a regulatory point of view, we are registered with the National Credit Regulator. We are also POPIA compliant. Also, we are transparent with our fees with our clients. Just for those that question that is often asked also, how much does it actually cost the client? When we negotiate a reduced repayment for the client, our fees is based in the client's repayment. So for argument's sake, in Jared's case, he was paying 34,000. We reduced it to 21,000. Our fee, which is capped by the NCR, is included in that repayment, right? There's also attorney fees that also included the repayment. What's the repayment? It's dependent on the client, but it is capped at 8,000, just so you know. And then also, there's also, we get to look after the client, and there's also a management fee as well that's also built into the client's monthly repayment. So if the client's was paying 34,000, we reduce it to 21,000. There are no additional costs to the client. Everything is factored into the client's monthly repayment. Now, in conclusion, very importantly, that we are here in partnership with you and not in competition with you as financial advisors. Your client remains your client. We're here to support, not compete. As I said, we are not a FSP. We do not have phase reps. We operate under the ambit of the NCR, but our approach still works on the fundamentals of financial planning in the sense that we take the same approach you would with your client. The only difference is we address the debt issues as opposed to the wealth creation and wealth protection. And together, we believe we can build financially resilient clients and for you, a stronger practice. Now, just how do you work with us? If you are interested in working further with us, you can scan this. It will take us to our website, to our social media, as well as to our contacts, etc. Add it to your contacts. And from there, we can see how we can work together to create a more financially resilient client and improve your practice by offering a more holistic offering. And yes, just protect your overall business as well from lapses and withdrawals, etc. And yeah, it looks like I've just about have 10 minutes available for questions and answers. So it is a webinar basis. It will be via the Q&A. But yeah, if there are any questions, you can either ask it in the chat or you can ask it in the Q&A. Also, the video recording will be sent out to all attendees. You are welcome to share it with your colleagues. Yeah, any questions, anything that I did not cover, anything that maybe is of interest? Okay, I see there's a few questions coming up. Sorry, I'm just waiting for, I see there's a few questions being typed. So you're welcome to leave your questions in the Q&A or on the chat. Alternatively, if there are questions you also want to ask me directly, I think most people also have my contact details in my email. You're also welcome. Oh, thank you. Oh, thank you, Isham. I'm quite happy. Maybe just by maybe a quick poll, if I can maybe ask, how many of you do you see that this is a service that could add value to your practice? To possibly reduce lapses, to possibly reduce withdrawals from clients' investments, to offer a more holistic offering? Do you see it as something that can be incorporated? I mean, just as a quick survey. Okay, that's good to know. So just like I said, if you want to partner with us, um, feel free. I think there are a few advisors already that have already partnered us. So just so you know, we